Aegis Vopak Terminals. It's one of the country's largest owner and operator of tank storage. To begin with, sir, give us a sense of Aegis Vopak. It's a subsidiary of Aegis Logistics, which is already listed in the markets. Give us a sense of how big is it and the business verticals that it caters to.
Yes, thank you for having us, and very great that we are able to come online and speak about the IPO and our company. Aegis Vopak Terminals Limited, like you said, is a joint venture between two independent listed companies. One is Aegis Logistics Limited, a 1978 listed company formed in 1956, a pioneer in tank terminal storage business since long, and also a market leader. And Royal Vopak, of course, its joint venture partner in Aegis Vopak Terminal Limited, is a global leader in terminaling business, doing the same business last 400 years and present in 23 countries, a AAA ESG MSCI rated company. So this joint venture was started to do terminaling business in India, and it started its journey in May 2022. Why we chose a separate vehicle was because in the parent we were also doing business other than terminaling, which was basically distribution and sourcing in LPG. So therefore this vehicle was needed because Vopak and Aegis decided to do only terminaling business in this SPV. So like I said, this journey started in May 2022 with a 0.5 million CBM liquid storage space and 5.6 million tons of LPG throughput capacity in May 22, and currently we are already triple in liquid, 1.7 million CBM storage space, and in LPG in H1 of the current year we would triple to a 15.6 million tons of LPG throughput capacity. We are currently operating 22 working sites. We have developed 225 acres of port lease land. In this JV, we are present in 6 ports. So basically, we handle liquid and LPG in storage tanks for our client at a fee. The infrastructure is simply a jetty pipeline which unloads the product. In the middle there is storage tank, and then you evacuate the product for the clients, either by filling it in road tankers or filling up rail wagons or hooking into a pipeline grid which the customers want the product to be delivered.
Sir, 2,800 crores you're raising in fresh, and you had raised around 800 crores through private placement in the month of October, November as well. Can you tell us the utilization for this fundraise?
So this equity issue of 2,800 crore is a primary equity issue. As such, all the money comes into the company. And we are going to retire all the bank borrowings currently on the books, which is 2,016 crores. All of those are going to be paid off, and you will reset the borrowing meter to 0. And we are also going to utilize 671 crore to pay for our upcoming cryogenic LPG terminal at Mangalore Port. So that is the balance payment on commissioning which is payable. So that is how the 2,800 crore odd is going to be utilized. Balance, of course, a small bit is for general corporate purpose.
Sir, when you started the company, it was a 5149 company. Then you are holding little above 50% at the time of IPO. Post IPO, how will be the shareholding between you and Vopak?
So this particular issue would dilute around 10.75% of equity shared, of course depending on the book building and the price and how many number of shares would eventually be issued, but approximately if we take around 10.75%, both the partners would equally dilute. So obviously we are going to come down from 50.1 to around let's say 44 point whatever odd decimal it is, and similarly Vopak would come down from 47.3% to 10.75 divided by 2, and you subtract, and that is the shareholding which Vopak will have. Both the partners are going to equally dilute.
Sir, give us a sense, because this is a subsidiary of a listed entity. How would it change the P&L for the for the parent in that sense? Because now you won't be holding more than 50% in the company, so the consolidation would be only on an equity method. So will that have an bearing on the balance sheet or P&L of Aegis Logistics consolidated?
No, we believe that in spite of the dilution and we going down below 50%, as there is management control over the subsidiary, the consolidation will happen line by line. And the only thing that will change in the parent is there will be an increase in minority interest, but that we feel will be compensated by borrowing having gone to zero. Therefore, interest expenses will come down, and that would be a compensatory in nature if you look at on a thumb rule basis. So we don't think there is going to be any major change as far as the parent is concerned.
I understand from the RHP that Aegis parent would be receiving around 180 odd crores subsequent to this IPO. Is that part of the new shareholding agreement that you have with Vopak? And how does Vopak manage its shareholding? Is it open to selling further in the market going forward?
Yes, so 180 crore is what we get once we complete this issue. This was always the understanding when we did the joint venture way back. And with Vopak, it is like I said in the beginning, this is a joint venture. So we have entered into an inter-se agreement with Vopak, which is part of the DRHP, that there is not going to be selling of shares by Vopak for at least 3 years. That is there in the inter-se agreement between the shareholders.
Give us a sense, now that you will become zero debt on the balance sheet, your finance cost was coming around 170 odd crores for FY24, and I assume that could be the same range in FY25. Will that entire 170 crores now follow through to the to the profit?
Yeah, so most of it, because there is a small element of Ind AS 116 where interest portion is there. So if you count that, because that is actually non-cash, but other than that, all cash bank borrowings are going to be paid off. So interest will come down substantially. You can take it like 2,000 crore you are paying, and let's say around 8% is your borrowing cost. So like you said, 170, this would be 160 crore, which would go down if we just take a...
Because it's a it's a infra, and you can easily look at the kind of cash flows which is coming in, right? I mean, so on a quarterly basis, you're getting a cash flow from operation of 330 odd crores, 70% plus margins you're sitting on, being an infra company. Is it fair to say that FY26 your top line would be around 250 odd crores, because that's the kind of pass-through of interest that comes in, and the organic growth that you're seeing 20 to 30%, which is coming in as well?
So we cannot make any forward-looking statement. So I will comment on what is the past performance, which is there in the DRHP. But I think any P&L is as a result of your actions. So typically any company would see a growth on account of higher utilization of its asset. If it is an infrastructure company, there will be growth and profits if you set up additional capacities. There will be growth if suppose you have pulled down your borrowings, and interest expenses will go away. So it's a combination of lot of factors eventually. But yes, it's looking good. That is how it is meant to be. The journey which we call Gati, that is putting speedily infrastructure in the country for liquid and gas.
Okay. Finally, sir, I'm seeing your gas volumes are rising on a year-to-year basis, and your future capex is also coming into the gas segment. Do we see a higher revenue stream coming in from gas, because the turnaround of gas is also much higher as compared to your liquid, because your liquid capacity is, if I'm not wrong, is utilized only 70% odd. So, there is a higher volume and higher demand for gas storage as compared to liquid. Is that the understanding I'm getting?
The liquid, when you say occupancy is 70% plus, so it's occupancy, but you see the charges which are levied for liquid cargo are based on capacity per month. So in case a product exits out even before the month ends, and you remain empty for the balance period for that month, you have already earned the revenue because the rates are per month basis. So occupancy is not the right yardstick. What you have to do is you have to earn capacity on your capacity. So if you have realized your per month rate, it does not matter whether the occupancy is 70% or not. In case of gas, you are right. Gas utilization increases if you have multimodal evacuation mode. So if you are having only road evacuation, there will be a limitation to your growth. Then you keep adding rail evacuation mode, or you hook into pipeline grid. Currently LPG is having so many government-owned pipeline grids. For example, Kandla-Gorakhpur pipeline is coming up, Jamnagar-Loni pipeline, Mumbai-Chakan pipeline, Panagarh, you have Paradeep Durgapur pipeline, then you have Mangalore Hassan Chirapalli pipeline. So if you are able to connect into those pipelines, the evacuation simultaneously happens and enables you to utilize your asset more, which will be higher revenue and higher profits. The endeavor, and we always strive to do that. In addition to setting up additional capacity, we also strive to see if our utilization is growing every year.